For decades, Japan was the quiet constant in global finance. While the rest of the world raised rates, cut rates, panicked, and reacted to crises, Japan stayed still. Near zero interest rates. Year after year, decade after decade. That stability wasn't just a domestic policy choice. It became one of the most important pillars holding the global financial system together. And this week, that pillar moved. It didn't collapse. It didn't shatter. But it shifted, and markets around the world felt it immediately. All it took was a single comment from Tokyo. The governor of the Bank of Japan suggested that policymakers would review the possibility of raising interest rates at the upcoming meeting. No announcement, no decision, just a review. But in global finance, signals matter more than statements. Within seconds, Japanese government bond yields surged. The 2-year yield broke above 1%, a level it hadn't touched since 2008. The 10-year yield jumped sharply as well. That might not sound dramatic if you're used to US rates. But for Japan, it was seismic. Because Japan has spent nearly 30 years anchoring the world with ultra-cheap money. And the moment markets sensed that anchor might loosen, everything reacted. Bond markets from New York to Frankfurt repriced risk. US Treasury yields jumped. Expectations for aggressive Federal Reserve rate cuts were suddenly pulled back. This wasn't about Japan alone. It was about what Japan represents. Japan is not just another economy adjusting policy. It is one of the largest suppliers of global liquidity on Earth. For decades, Japanese capital flowed outward, quietly financing governments, corporations, and asset markets across the world. And now investors are being forced to ask a dangerous question. What happens if that flow reverses? This video is not about panic. It's about understanding why a small shift in Tokyo can ripple through bonds, currencies, stocks, and your portfolio. Because the most dangerous moments in markets don't begin with crashes. They begin with signals. And Japan just sent one.
To understand why this moment matters, you first need to understand the role Japan has played behind the scenes for decades. Japan didn't just keep interest rates low. It kept them near zero for almost 30 years. That decision turned Japan into the cheapest source of money on the planet. Global investors discovered something powerful. They could borrow in Japan at almost no cost, convert that money into dollars or euros, and invest it elsewhere for higher returns. This strategy became known as the carry trade, and it quietly reshaped the modern financial world. Governments benefited, corporations benefited, asset markets benefited. As long as the interest rate gap existed, the trade worked. Borrow cheap in Japan. Invest in higher-yielding assets abroad. Pocket the difference. For years, this flow of capital acted like invisible glue. It helped finance U.S. government deficits. It supported European bond markets during repeated crises. It kept borrowing costs lower than they otherwise would have been. Japan became the silent lender of last resort. Over time, Japanese investors accumulated trillions of dollars in foreign assets. A massive share of that money went into U.S. Treasury bonds. That demand helped stabilize American interest rates even as U.S. debt exploded. Markets came to depend on it. Cheap money felt permanent. Liquidity felt endless. Risk felt manageable. But in finance, permanence is often an illusion. The carry trade only works under one condition. Japanese interest rates must stay lower than everyone else's. The moment that condition changes, the entire calculation changes with it. Returns shrink. Currency risk grows. And suddenly, what once felt safe begins to look fragile. That's why a single sentence from Japan's central bank mattered so much. It wasn't about what they did. It was about what they might do next. Because if Japanese rates rise, even modestly, the logic holding trillions of dollars in place starts to break. And when that logic breaks, capital doesn't hesitate. It moves, quietly at first, then all at once. And that's where the real danger begins. Here's where this story stops being abstract and starts hitting real markets. When Japanese interest rates rise, even slightly, investors begin to reassess risk. Borrowing in Japan no longer feels free. Currency volatility becomes dangerous. And suddenly, the carry trade stops making sense. So what do investors do? They unwind. They sell foreign assets. They repay yen-denominated loans. And they bring capital back home. This doesn't happen in a dramatic headline-grabbing moment. It happens quietly, but the impact is enormous. Less Japanese money abroad means less global liquidity. And liquidity is the oxygen of financial markets. When liquidity fades, borrowing costs rise, risk premiums expand, and asset prices come under pressure. The United States is especially exposed. For years, Japan has been one of the largest buyers of U.S. government debt. That steady demand helped keep Treasury yields lower than they otherwise would have been. But if Japanese investors slow their purchases, or worse, begin selling, the consequences ripple fast. U.S. bond yields rise. Mortgage rates stay elevated. Corporate borrowing becomes more expensive, and the Federal Reserve loses flexibility. At the exact moment America is running massive deficits, one of its most reliable lenders begins to step back. Europe faces an even more fragile situation. High debt levels, weak growth, repeated fiscal stress. Without Japan absorbing risk, those vulnerabilities become harder to hide. Emerging markets feel it too. Many relied on cheap global capital to finance growth. When that capital retreats, currencies weaken, debt costs rise, and instability spreads. This is why global markets reacted so violently to what sounded like a small comment from Tokyo. Because it wasn't just a comment. It was a warning, a signal that the world may be entering a phase where cheap money is no longer guaranteed. And when that assumption breaks, markets are forced to reprice reality. Not gradually, but suddenly. Now let's talk about what this shift actually did to markets. Because it wasn't just bonds. Stocks reacted, currencies moved, crypto sold off. And that tells us something important. When multiple asset classes move at the same time, it's not noise. It's stress. After the signal from Japan, U.S. Treasury yields jumped sharply. That immediately pressured equities. Why? Because higher yields change the math. Future earnings are discounted more aggressively. Leverage becomes more expensive. Risk suddenly has a cost again. High-growth stocks felt it first. Technology shares pulled back. Speculative names sold off quickly. But what surprised many investors was what happened next. Bitcoin dropped hard. Not because of regulation, not because of headlines, but because liquidity tightened. For years, Bitcoin was marketed as digital gold, a hedge, a safe haven. But markets treated it like something very different, a risk asset. When investors de-risk, they don't debate narratives. They sell what they can. And Bitcoin moved in lockstep with tech stocks. That correlation matters. It tells us that when pressure builds, diversification breaks down. Everything that relies on abundant liquidity moves together. At the same time, the US dollar had one of its weakest weeks in months. Why? Because the interest rate advantage that supported the dollar is shrinking. If Japan raises rates while the Federal Reserve cuts, that gap narrows fast. Capital flows adjust, and currencies respond immediately. A weaker dollar isn't automatically good or bad. It depends on context. But combined with rising yields, falling stocks, and selling pressure in crypto, it signals something deeper. Markets are starting to price uncertainty, not collapse, not panic, but instability. This is what transition periods look like. Not a single crash, but synchronized tension across assets. And when that tension builds long enough, something usually gives.
Here's where this situation becomes especially dangerous. Because while Japan is moving toward tighter policy, the Federal Reserve is facing the opposite pressure. Inflation is not fully defeated, but growth is slowing. Manufacturing is contracting, and consumers are stretched. The Fed is trapped. If it cuts rates too aggressively, inflation risks reaccelerating. If it holds rates high for too long, economic stress builds underneath the surface. And now Japan's shift makes that balancing act even harder. For years, global capital flowed into U.S. assets because America offered higher yields. That gave the Fed room to maneuver. But if Japanese yields rise and capital starts flowing home, the Fed loses that cushion. U.S. borrowing costs stay elevated even if the Fed wants them lower. Markets don't wait for policy intentions. They respond to capital flows. This is why expectations for future rate cuts have been pulled back. Just weeks ago, investors expected deep cuts. Now, that certainty is gone. And uncertainty is toxic for markets. Looking ahead to 2026, the risk isn't a single dramatic event. It's prolonged instability, volatile bond markets, choppy equity prices, sudden currency swings. This is the kind of environment where confidence erodes slowly, then breaks suddenly. And there's another layer of risk: leadership uncertainty at the Federal Reserve. Any change in tone, strategy, or credibility at the top magnifies volatility. Markets don't fear bad news the most. They fear unpredictability. Japan's move didn't create these problems. It exposed them. It revealed how dependent the global system has become on cheap capital staying cheap forever. And when that assumption weakens, markets are forced to adapt. Not comfortably, but painfully.
So what does all of this actually mean for you? Not as a trader, not as a hedge fund, but as a real investor trying to protect and grow your money. First, this is not a call to panic. Markets go through transitions like this throughout history. What matters is how you think during them. Periods of global tightening don't usually destroy wealth overnight. They expose weak positions. They punish excessive leverage. They compress valuations built on optimism instead of cash flow. And they reward patience. This is the environment where clarity matters more than prediction. You don't need to guess what Japan, the Fed, or markets will do next week. You need to understand the direction of pressure. Higher borrowing costs, less global liquidity, more volatility. That means risk needs to be sized carefully. Speculation becomes dangerous. Leverage becomes unforgiving. Narratives lose their power. This is when investors should ask simple questions. Do the companies I own generate real cash? Can they survive higher rates? Do they rely on constant refinancing? If the answer is unclear, that's already a warning. Diversification matters more in transition periods, not less. Not diversification across hype. Diversification across resilience. Assets that don't all depend on the same assumptions. And perhaps most importantly, avoid emotional decisions. Markets often move sideways and violently before trends become obvious. Selling everything at the wrong moment or chasing safety too late can be just as damaging as ignoring risk. This is not about timing a crash. It's about recognizing a regime change and adjusting calmly. Because investors who stay rational while others react emotionally are the ones who emerge stronger on the other side.
What we are witnessing right now is not a headline event. It is a transition. For decades, the global financial system was supported by one assumption: that cheap money would always be available somewhere. Japan played that role longer than anyone else. Now, that era is ending. And when a long-standing support is removed, the system does not collapse immediately. It adjusts, slowly at first, then all at once. Capital becomes more selective. Risk is repriced. And certainty disappears. This is why the next few years will feel different from the last decade. Returns will not be automatic. Volatility will not be temporary. And stability will have a price. But periods like this are not only dangerous, they are defining. They separate speculation from ownership, momentum from value, noise from signal. Investors who understand these shifts early don't need to predict exact outcomes. They position for resilience. They reduce unnecessary risk. They protect optionality. They stay flexible. History shows that the biggest mistakes are not made during crashes. They are made during transitions, when people assume the old rules still apply. Japan didn't pull an emergency lever to shock markets. It revealed something deeper, that the world is entering a new financial phase. And those who recognize it will not just survive it. They will be prepared for what comes next. If this breakdown helped you see the bigger picture, make sure you're subscribed, because this story is just beginning, and we'll keep connecting the dots as the system continues to change.